This accounting mini lecture covers the investing activities of the statement of cash flows. When we're preparing the investing section on the statement of cash flows, we're going to use a basic three-step approach. We want to first identify changes in the investing related accounts. We're then going to explain those changes by looking at the entries that generated the changes, and then we're going to determine how this impacts our cash flow. Okay. Now, when we are looking at investing activities, the type of accounts that we're going to be concerned with are going to be our long-term investments, our marketable securities, our property, plant, and equipment, which are, again, our long-term assets. All of these account changes are going to be reported in the investing section. Now, when we look at this particular balance sheet, it looks like what we have here are long-term assets, property, plant, and equipment. They call them plant assets. Sometimes they're also called fixed assets, but they're all our long-term property, plant, and equipment. Now, what we see here in looking at the comparative balance sheet, we see that the actual plant asset account changed by $40,000 between the 2 years, and we also see that our accumulated depreciation changed. However, just looking at the comparative balance sheet, we don't know exactly why these accounts changed. We don't know how they changed, and we don't know how it impacted cash flow. So we're going to have to reconstruct the entries that cause those changes. Now, in real-world accounting, this would actually be fairly simple to do because in the accounting system, we could simply drill down to the underlying transactions that generated those changes just by basically drilling into the account balance. And here, this is basically what they've done just, through the use of manual entries. What we see here is, first, it looks like we purchased some plant assets. We purchased the assets for $70,000. However, we used a $60,000 note payable, and we only paid $10,000 in cash. Looks like we also sold some plant assets for $30,000, or costing $30,000. And it looks like we received $12,000 in cash. And then anytime we sell assets, remember, not only do we have to take the asset off the books, but we also have to remove the associated accumulated depreciation. And then in the third entry, we can see the journal entry that was actually used to record depreciation expense. So let's see how this is going to impact our statement of cash flow. Okay, the bottom of the screen here, we see our cash flows from investing activities. We can see the cash received from the sale of the plant assets was $12,000. The cash paid for the purchase of the plant assets was $10,000. So, of course, because that's cash paid, that's a negative $10,000. So our net cash provided by investing activities was $2,000. Now, something else noteworthy, if we look up here in the operating section, what we see is our $24,000 depreciation expense, and we actually saw that on the previous slide. So this basically shows you why it's important that we back out that non-cash expense in the operating section because it did not actually impact our cash balance. Thank you for watching this video on the investing activities on the statement of cash flow.